In this video, we're going to look at the best performing stocks over the last decade. Can be important because even though these stocks may not be the best performers over the next year, the next 5 years, the next 10 years, what it does show us is when we look at these stocks, how did they end up performing so well? And what we generally find is that really strong performing stocks have very strong earnings growth. So the company itself that the stock is based on is growing their earnings that the company is making, which then incentivizes investors to buy that stock, because when you're buying a stock, you're essentially taking ownership of a piece of that company, which then means you're entitled to some of that earnings. Or at least you own a share of that earnings. So then when those earnings are growing, that generally is going to incentivize people to buy the stock, which pushes it up. We also have situations where a stock can rise, not necessarily because the earnings have been growing, but because they're expected to grow. So we have one on our list where this basically happened to, and the other ones on the list, they have strong earnings growth and they're expected to continue doing well. So this is the stocks. So number one, Nvidia over the last 10 years, and this does have a volume metric in there. You can see all these stocks doing at least 1 million shares a day, and all of them are priced over $5. So there's no like penny stocks on here or anything, and generally unless they've turned into a big stock, they're not going to make this list anyway. So this is a little bit bigger companies with nice daily average volume. Nvidia, the top one, 27,389%. That's the total return over the last 10 years. And when we talk about earnings growth, 66.7% average yearly earnings increases over the last 5 years. So that's every year on average they've increased by 66.7. Now, some years would have been less than that, some years would have been more, but that is the average earnings growth. Then we can look at what analysts are expecting in terms of growth per year. Average per year, 46.4% per year going forward over the next 5 years. That's what's expected. So you combine a solid track record of really being able to grow earnings plus a really solid people still expecting the company to be able to grow their earnings significantly, and that produces one of these big returns. What's interesting here is that 27,389% is 75% compounded annually. So this is the annualized return. Basically taking this amount, how much would you have had to make each year? 75.4%. So 75.4%, that seems really high, but when you look at 27,000%, 75% doesn't seem like that much. But if you make 75% this year, and then you have those profits, and then the next year you make 75% on that, and then you make 75% on that the next year, that's how you end up at 27,300%. So really strong, and you can see the current year and next year very strong. Celsius Holdings, they make energy drinks, 26,318%. Same story here. Really strong EPS over the last 5 years, increasing at more than 100% per year on average over the last 5 years. And again, expected to grow significantly each year over the next 5 years. Again, this is forecasted. We don't know if it'll actually happen. And you can see the chart down here. So just big upswing, and it's even fallen quite a bit from its high. And we go over here, annualized return just under 75% per year in order to over 10 years in order to get that 26,300%. Again, current year and next year expected to have really strong earnings growth. EXPI, this is kind of a cloud-based realty company, real estate. And this is one of the ones where it was more about hype and expectations than actual earnings. You can see the price to earnings ratio along the bottom here. When there's nothing, it generally means there were no earnings. And you can see, so very sporadic earnings. They've only had, a few quarters in here where they had actual earnings. Then they have had some earnings over the last few years. And there was a little gap where there were no earnings, maybe a negative quarter, and then no earnings recently. So negative again in terms of earnings. So the company's hasn't been very profitable, yet it's still up 6,280% over the last 10 years. And you can see this really huge spike. There was a lot of euphoria in 2020. Remember, that was COVID. So the market dropped early in the year, and then everyone was sitting at home, and the market had kind of a gangbuster year where everyone was buying stocks, sitting at home. And this was one that really benefited from that hype because a lot of these kind of more speculative companies really got bid up. And this one went from under $5. You can see here was kind of near the start of the year, let's say around $5, sometimes even a little bit lower. And it went all the way up to above 85 very briefly. Now it's trading down at 12. So it's lost most of that. But even with this huge drop from 85 down to 12 over the last 10 years, where it started way over here, where it was basically a penny stock, still up more than 6,000%. So still kind of living off that hype, even though it doesn't quite have the same story of these other ones, where they really did end up actually having the strong earnings growth. AMD, probably familiar with that one, Semiconductor Company, and 3,790, rounded up, 7,394%, 30.8% EPS average yearly growth over the last 5 years, and even better going forward, 33.2%. And you can see just kind of this long-term uptrend the stock has been in. A couple years where it had some non-profit years or negative earnings where it didn't make any money, but overall has done really well in terms of its overall growth. How do you end up at a 3,794% return? You got to make 44% per year on average over 10 years. SMCI, 3,191%. Really strong earnings growth. Again, 66.7% per year over the last 5 years. And one of the highest expected earnings growths going forward, 62.4%. So just another one of these stocks that has really been able to grow its profitability over time and is expected to continue to grow that profitability. And in order to get a 3,090% return, 41.8% per year. AMD expected to do well over the next couple years as well, current year and next year. This is the expected earnings growth for the current year and next year. And same with SMCI. Huge jumps in current year and next year growth expectations. You can also see how they kind of rank in terms of financial health. You can see Nvidia very strong, Celsius very strong, EXPI a little bit weaker. These are Morningstar ratings just on their financial health. C would be kind of probably the lowest level of investment grade that we consider. It's still a pretty solid company, but not as good as A or B. You can see it's kind of colored in yellow, just saying a little bit of caution, but still pretty good. And SMCI, also C. You can also see sales growth, also important. You want to see increasing earnings accompanied by increasing sales. If you have just increasing sales with no increasing earnings, you wonder why is that company not making more if they're bringing in more revenue. And if earnings are really increasing without the sales, you start to wonder if it's just accounting gimmicks or they just had a bunch of layoffs or something like that, so it's kind of more of a temporary thing. But when you have earnings increasing with sales, that's a really good thing. And that was one thing about EXPI. Even though the earnings growth wasn't there, really solid revenue increases, 43% per year. That's really good. In these last few, you can see SMCI. We'll bring up the chart there just so you can see it. SMCI, most of those gains coming recently over the last couple years. So that's your top 5 performers over the last 10 years and basically what helped drive them higher.